Indicators are the first line of offense that many people use when starting trading. Most trading platforms have every indicator from A to Z. They're tools, and like a tool in a toolbox, each has a proper usage, and they are only as good as the person who is using them. Now, just because I can use a hammer doesn't mean I can build an award-winning treehouse. Indicators lag price, and that is often spoken from the rooftops in a negative way by those with some other agenda, like the trading system they are selling. Look, lagging is not a bad thing, and while picking tops and bottoms can give you a smaller risk profile, most traders make their money in the meat of the move. I tell people I speak with to use what the chart shows you first and indicators second. Now I'm going to point out two ideas, but there are many, many more that you can discover. Now, many people use moving averages for trend determination. With a quick glance, you know if the market is up or down or sideways, according to what you determine accurately shows the current trend on the time frame you are looking at. If price is trading above this moving average, we look for longs. Trading below it calls for shorting opportunities to be hunted. Now, we can also just use the slope, but then we have the whole question about how much slope do we need. Now, notice the red arrows. All I have there is a 5-candle pattern. A high, for example, needs a candle in the middle with its higher high higher than the two on either side of it. Lows would need higher lows on either side. Now, since an uptrend makes higher highs and higher lows, it can be pretty easy to see the trend through price action alone. A downtrend would need lower highs and lower lows. Now, you see that yellow line? That shows where price, after making a lower high, breaks through the lower low. Now, at that point, we are looking for shorts. Are you in a trade and you want to get out? Start marking off highs and lows and see where the pattern changes. Now, you can be aggressive and only need one candle on either side, or be a little conservative and need two. Now, for lower time frames, you may want to use conservative, while higher time frames use aggressive. Now, how about the RSI with level 60-40 instead of the usual 70-30 as taught by my mentor years ago? Now, many use the oversold and overbought levels to enter trades. How about using price first and then the RSI? Now, we see a downtrend line broken and then a test of the back of the line. Now, we are going to be conservative and take the second bounce off the number one trend line, which also coincides with the support level that formed off of the backside of the downtrend line. Now, to confirm this trade, look down at the RSI level dipping down around the 40 line, showing that price is supporting at that level as indicated by the indicator. You watched price first and then you confirmed with an indicator. Now, what about taking profits? These red lines point out significant turning points on this view of the chart, and they are a good location to start looking to take profits using price levels first. The RSI comes after we see a market structure area for potential action. Now, this is where the RSI was when price hit the area. It's above the 60 level, which can indicate a possible turning point in the near future. This can also give you an objective mechanical way to manage your trades. I hope you use this information to find more ways that you can use the price and indicators for high probability trading.